Hello and welcome back once again. Today we're going to talk about Bed Bath & Beyond, a company that everybody who has lived in the United States for at least a while has definitely been in to buy some stuff for their home, for their bath and beyond. And so we will examine the company and take a look at the financials and what's going on and whether it's a potential interesting addition to a portfolio, our portfolio. The company has been enjoying some growth in the previous years, but then suddenly fell off a cliff, and the last year has been down about 54%, which is massive, obviously. And the interesting thing to notice here is that their short interest is very, very high, is sitting at almost 30%, which means that if there is some positivity at some point, if there is some positive sentiment, then the company stock price can really, really hike and potentially explode. So bear that in mind when you're making your investing decisions for this one, especially your trading decisions, I should say. Interesting thing, the outstanding shares of this company are massively going down. They used to be almost 236 million in 2012, and so the company has been buying back shares all the time. And I was curious about this, and I took a look at some announcements that they made in the past, and they mentioned it that they would be buying back shares till 2023, really. And so that's very, very interesting and worth knowing about. They will keep buying shares till 2023. So there is a little bit of a cushion here if you're interested in purchasing the stock. So what else about this company? The company has a market cap of $1.5 billion, and we will examine whether that is sensible or not. But let's take a look. Let's first take a look at the dividend, because the company used to pay a dividend, and they are not paying it anymore. And so you can understand that this has definitely caused some havoc among investors, and definitely has been a reason why the company's price has fallen off a cliff. And that's very, very important. If a company is actually cutting down on dividends, that can really, really hurt its stock price. So let's take a look at the income statement. The interesting and the dire thing about Bed Bath & Beyond in terms of its revenues is the year-over-year growth, which is negative right now. So the company is actually losing revenue year over year. You will see here that it used to be 12 billion and now it's sitting at 8. And the same thing goes with gross profit, as you'll see, like similarly losing gross profit, and also the net income. The net income, you will see that it's going down as well, from 600 million, almost 700 here, down to 400 million. So yeah, things are looking a little bit weird about the income of the company, and so that's something to definitely notice and remember when you're taking a look at the company and deciding whether it's worth adding to your portfolio. The balance sheet. And actually, before I move to the balance sheet, I wanted to mention something that's very important. Bed Bath & Beyond, obviously being a retailer, was severely affected by the pandemic. And so if the pandemic, at some point resides, we can easily see Bed Bath & Beyond going back to its normalcy and going back to making some of its regular revenues, which was at around 12 billion, or potentially even more. And so this is something that you have to bear in mind when you are making your decision, again, because this current situation with the pandemic may, at some point will disappear. And so you can see these retailers that have been completely beaten up all of a sudden, rise from their ashes and come back to normal revenues and normal financials. And if that happens, you could see their stock prices really, really climb at some point, and especially when they have that high of a short interest and that low of an amount of shares, outstanding shares, which also means that they have a low float being the amount of shares that can be actively traded during the trading day. And so when that happens, you have a low supply and high demand, which can really, really skyrocket the price of the stock and cause a massive short squeeze. And this is one of the reasons why I wanted to make this video, especially since the price of the stock went up 12% last Friday. So that's very, very important. You may see some positive sentiment that can lead to a potential short squeeze because of the insanely high short squeeze ratio right now. So yeah, let's take a quick look now at the balance sheet. And the thing that I wanted to point out in the balance sheet is the total equity over here. You will see that is going down and down and down, and that's obviously not great to see. And means that the company is basically liquidating assets, whether that's investments or anything else that the company could be holding in terms of assets. Company seems to be liquidating assets in order to pay liabilities, and so that total equity gets decreased. And you can obviously take a look, a detailed look, if you really want, at the total liabilities here and see where, what kind of liabilities the company had. And it's mostly debt, as you will see here. It's debt infestation, pretty much, that the company had to, at some point pay back. And so this is why you're looking at a company that's which has decreasing assets, really. And so that's not a great thing. They still keep buying back shares, though, which is interesting, to tell you the truth. But the cash flow from operations, what's going on here? $1 billion in 2017, and then steadily decreasing. Actually, it was kind of similar in 2018 and 2019. It actually increased in 2019. So before the pandemic, I guess things were normal, and then they started going really south, and now they're actually in the negative in the last 12 months. And that makes sense just because of the pandemic, and it could potentially even dissipate when we go back to normal. Cash from investing here, so it looks like they had to sell some of their securities over here just to pay back debt liabilities, and issued some more debt over here. Still, this is in the negative, so for the most part they are paying back debt, it looks like, and repurchasing stock. Like, they really like repurchasing common stock over here. Like, are they liquidating their assets to repurchase common stock? That's very, very weird. But they are repurchasing common stock in the millions over here, so that's very interesting. And also paying back some debt. Okay. So free cash flow, 670 million here, 480, almost 600, 385, and now in the negative, massively in the negative, $500 million in the last 12 months. And as you would expect, the solvency here will point out that the company has massive debt when you compare it to equity, just because they sold a lot of equity. And since they don't have almost any equity right now, they have very little equity, as we saw. The debt that they had, even though they didn't get more debt, is 5 times their current equity. And so for every $5 of debt, they have $1 of equity, which means that they really need to sort out the situation very quickly and start being positive again in terms of cash flow. Otherwise, they can even potentially bankrupt. I mean, this is not a good situation to be in. Or they will have to finance the company from stockholders. Instead of buying back shares, start issuing more shares. And in both situations, that's not great for investors, or whatever the case is. The only good thing for investors would be if the company actually goes back to profitability, which is what they would and should strive for. And so this is what's going on with this company. I think you have a full picture of what's happening with their financials, and you can make a decision. For me, I think the company is a very, very interesting play for a trade. I would be very, very interested to trade this company, especially with all these insane highs and lows that the company has. Like, you see that it moves massively, even in a 3-month period over here. And look at the 3-year period, massive movements. And that's, again, a very, very important reason for that is the amount of outstanding shares. There are very, very few shares around, so low supply. And also the fact that the company has been going through transformations just because of the pandemic. It looks like it's severely affected their bottom line. And so you are looking at a company here that could be a potentially interesting buy if you are a little bit of a riskier investor and you want to potentially buy a little bit of this company, just a few shares, just to wait it out and see whether they will be able to go back to their normal self and start selling again as if it is before the pandemic, which I think has a probability, like a potentially high probability even to happen. I think at some point people will go back to retailers, and maybe even soon. And the very, very interesting thing also is the fact that the market cap of the company is $1.5 billion right now, which is extremely low when you compare it to what they previously were making. So if we go back to the free cash flow statement, the cash flow statement here, you will see that the company at some point, let me go to the free cash flow, the company at some point was making an average of 500 million, again, before the pandemic. It's not like 10 years ago, it's like exactly before the pandemic. It was making 500 years, half a billion, 500 million, $500 million a year. Which means that with the current market cap, that's a multiple of 3. So the free cash flow of the company being at $500 million, if you give it a multiple of 3, as we mentioned, is going to be 1.5 billion, which is the current market cap. This makes it a very, very undervalued company if it actually goes back to its previous years. And so if you give it a multiple of kind of a normal multiple for a retailer of that sort, maybe 15 to 12 or something of that sort, you would be looking at a much lower free cash flow than what the company was actually making here. And so this points again to a company that is a potential nice target just because it can give you a very, very nice market cap when you compare it to its free cash flow. And you could find yourself having a company with a multiple of 3 times free cash flow, which is very, very awesome to hold and points to an undervalued company. So hope you enjoyed the video. I forgot to say that in my case I would potentially buy this company for a trade. I would be a little bit cautious about buying it for a long-term hold. However, I wouldn't mind getting a little bit of it and see how that plays out after the pandemic resides completely. Maybe we're in for a surprise with Bed Bath & Beyond, and especially having this kind of short interest also points me to think that there may be a massive squeeze later on at some point. And so I would potentially buy a little bit of this. I wouldn't go overboard, but I would still buy a little bit of this and just wait it out, see how that plays out. So thank you for watching the video. If you did enjoy it, please leave a like and subscribe again, and I'd love to see you on Discord. And in the meantime, you can take a look at this video that I made about Tesla. And I'll see you in the next one. Bye bye.